Hello everyone, welcome to Optiongig. This is your host Vivek Somani. I am an option trader by passion and a full-time software executive by profession. If you want to learn how to generate consistent monthly income trading options while working full-time in your day job, then join me in this journey. On the menu today is option pricing and option Greeks. This is one of the topic which differentiates between the professional trader or a serious trader and a novice or just a dabbler. And a clear understanding of this means the difference between making money or losing money in option trades. This is a little more intense topic, but if you stay with me, I'll try to break it down into simpler language so you can get a complete understanding of how the option pricing and how option Greeks work. Okay, so this is what we have in our menu today. Number one, we'll understand what factors impact the pricing of an option. Number two, how the option Greeks quantify that impact. So these two topics will give us a very good understanding of how and why the option prices are changing. Alright, so let's look at some of the basic concepts. Option prices do not stay constant throughout the expiration cycle. If you already started trading in options, you would have seen that the option that you bought, the price of that option keeps changing as the days are advancing. Or the option that you sold goes through a similar change in the option pricing. To know how the option pricing will change and the impact of those changes on your position, it is very important to understand the factors that impact the pricing. So in stock, there is, except the current market price of the stock, there is no other factor. So if you have only stocks in your portfolio, then the value of your portfolio is determined by the current market price of the stock and nothing else. But in options, apart from the current market price of the underlying stock, there are other factors that also cause an impact on an option pricing. In some cases, we have seen that even though the stock price has moved in a favorable direction, the option trade is still not profitable. Why? Because the other factors other than the stock price have gone in the negative direction, and hence the option trade is still unprofitable while the stock has moved in the profitable direction. The reverse is also true, in which the stock might have gone against your assumption, but the other factors would have helped you to turn the losing trade into a winning trade. So let's see what are the other factors are and how can they help us to predict how option pricing will behave. Okay, option pricing, it can be broken down into two parts. One is intrinsic value and the another is called extrinsic value. Like the name suggests, intrinsic means this is the innate value or the inherent value in the option. It is derived by the comparison of the strike price and the stock price. And don't worry, I'll give an example of it so that it makes very clear to you. Extrinsic is the value that is derived from the factors which are other than the stock price. Extrinsic value is sometimes also referred as time value because those factors are applicable only until the expiration of the option life cycle. So now let's look at an example of the breakup of the intrinsic and extrinsic. Now in this example, the stock price or the market price is $56, and let's say you are buying a call option at a strike price of $50. Again, stock is at $56. You are buying a call option at a strike price of $50. To buy that call option, the total premium that you have to pay is $8. It means the option value is $8. Now out of that $8, $6 is the intrinsic value. Why? Because that $6 is the amount of the money which is already embedded in an option contract. Because let's say if you buy this stock if you buy this option contract, which gives you a right to buy the stock at $50, you will immediately buy the stock at $50 and sell it in the market at 56. So the difference of $6 is embedded in this option contract already. So that is why it is called the intrinsic value. It is the innate value. Now, if this was the only component of option pricing, everyone will do it. This is not the only one. In addition of the intrinsic value, you also have to pay a time value premium, which is extrinsic. It means you are paying additional $2 as an extrinsic premium for this particular option contract. So if you are buying a call option at a $50 strike price, when the stock is at 56, you are paying $8. Out of $8, $6 is the intrinsic value and $2 is the time value or the extrinsic value. Now let's look at the various components of the option pricing. Now we talked about the intrinsic and extrinsic or the time value. Now intrinsic value is calculated by the difference between the spot price and the strike price. When I say spot price, it also means the current market price. So as we have seen in our previous slide, the difference between 56 and 50 is $6, and that is the intrinsic value. Now the extrinsic value or the time value is impacted by multiple other factors. So one is time to maturity. That means how much time is still there before the contract matures or before the contract expires. Second is volatility. How much volatility is existing in the underlying stock. How volatile the stock is. And the third is rate of interest. What is the current rate of interest prevalent in the market? Now these factors, the factors we talked about, which is time to maturity, volatility, and the interest rate. The impact of these factors can be calculated by option Greeks. There are 5 option Greeks: delta, gamma, theta, vega, and rho, and we will go through each one of them now. The first one is delta. Now delta is the amount of change in an option value for $1 change in the underlying stock price. If the underlying stock price moves by $1, how much your option will move is determined by the delta. So if the delta of an option is 0.30, that means that the price of the option contract will change by 30 cents if the underlying stock changes by $1. Now calls have a positive delta and puts have a negative delta. If you're holding a call option contract and your stock moves up by $1, your call option contract will also gain value of 30 cents. But if you're holding a put option contract, then when the stock goes up by $1, your put option contract value will be reduced by 30 cents. Next, theta. Theta indicates the change in the option value with 1 day change in days to expiration. Options have a finite lifetime. So as and when you keep getting closer to the expiration date, the theta will indicate the decay in the option value with every 1 day closer to the expiration date. If the theta of an option is 5, it means the price of option will change by $5 after a day. Now, when we are talking about these individual factors like delta, theta, when we discuss these examples, I'm considering that there is no change in other factors. Right now, we're considering the impact of these factors in isolation. If the theta of an option is $5 and today, let's say that option contract is valued at $20, nothing else has changed. Tomorrow, the same option contract will be valued at $15 just because you are now 1 day closer to the expiration date. So the change in the option contract value because of the change in the days to expiration is indicated by option Greek called theta. Next option Greek is Vega. Vega indicates the change in option value with 1% move up in a implied volatility of underlying stock. If you recall, the extrinsic value was determined by time to maturity, volatility, and interest rate. Now Vega tells you the impact on the option pricing because of the change in volatility. If the implied volatility is moving up by 1%, then the Vega will tell you how much the option pricing will change. For an example, if Vega of an option is 0.05, that means the price of the option will change by 0.05 if the IV or the implied volatility of the stock moves up by 1%. Conversely, if the IV of the stock goes down by 1%, the option pricing will decrease by 0.05. Alright, next is gamma. This is a second degree Greek because this is the rate of change of delta for $1 change in underlying. This is an additional money made on every $1 change in underlying. For example, we talked about delta, which indicates how much the option pricing will change if the stock is moving by $1. So let's say the stock moves by $1 more, then gamma comes into picture because it will tell how the delta itself would have changed. So considering in a real life, if delta is a speed, gamma tells you about the acceleration, which is the rate of change of speed. Next is rho. Rho indicates the change in option value with 1% change in the interest rate in economy. Generally, during the period of expiration that we trade in, which is between 40 to 60 days of maturity, the interest rates do not change. So I do not look at rho as closely as I would rather look at the other option Greeks. But it is good to know that if you really want to understand the impact of change of interest rate on your option pricing, you should look at the value of rho. Okay, so now let's understand the Greeks and how they are related to the various components of option pricing. So we go back to the familiar chart that we had seen earlier, in which the option pricing is divided into two major blocks, the intrinsic value and the time value or the extrinsic value. Intrinsic value is determined by the relation between the spot or the market price and the option contract strike price. Time value is determined by the time to maturity or time to expiration, volatility, and the rate of interest. Now, this is how the Greeks are related to the various components of option pricing. Delta is related to the spot price and the strike price, and so is the gamma. Impact of time to maturity is known by the value of theta. The impact of change in volatility can be measured by Vega, and the impact of change in rate of interest can be measured by the Greek called rho. Takeaways. One thing to note is that option prices are variable because the time to maturity is changing, the stock price is moving, the volatility can go up and down over the lifetime of the option contract. Greeks will determine how the option price change with the change on some of those factors. But please note that the Greeks do not give us a future direction of the stock. It tells us how the option pricing will change, but not really how the stock prices will change. I hope you find this useful. Thank you very much for your time. If you have any questions, please write it in comments or email it to optiongig@gmail.com. If you liked what you learned, please help us spread the word so others can also benefit from it. Thank you very much.